Good morning and welcome to Stock Market Today. It's Monday, January 13th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So U.S. equities finished lower on Friday, though the S&P 500 still posted a gain on the week of nearly 1%. Financials, industrials, and energy were the worst performers on Friday. Defensive sectors and healthcare outperformed. Treasuries were unchanged to slightly stronger at the long end of the curve. The dollar was weaker against the euro and flat against the yen. Gold finished up 40 basis points after suffering back-to-back declines for the first time since late November. WTI crude settled down 90 basis points and marked its worst week of trading since July. So your outperformers, REITs, utilities, and healthcare. Underperformers, financials, industrials, and energy. As we get to the desk this morning, futures are up 40 basis points after U.S. equities finished higher last week. Asian markets were mostly higher overnight, with China outperforming, while Australia declined and Japan was closed for a holiday. European markets are higher, though the upside is limited. Treasuries are weaker across the curve. The dollar is stronger against the major crosses. Gold is down 60 basis points, and WTI crude is off 10 basis points to get us going on a Monday morning. And as we check in on the structure of the S&P 500, well, what you can see is that we did trade to a new all-time high on Friday, and then we pulled back on the final day of what was a strong week, adding nearly 1%. Near-term support remains in that 3150 to 3200 range, and we continue to look for resistance levels to form, with the market trading up near all-time highs. The RSI is in bullish ranges. We've once again exited an overbought condition. Remember, on Friday, we'd poked back in to an overbought condition on the RSI, but the pullback on Friday takes us back below the 70 mark, but still holding bullish ranges, as we really have for the most part since breaking out in October. Chaikin money flow is also bullish, so the indicators continue to support the trend that we are seeing in price. Futures, as I said, are pointing to a higher open today. And just a reminder that earnings season really kicks off in earnest tomorrow, with the major banks beginning to report results. So continue to focus on the leading stocks and the leading areas of the market while managing risk. We've given you the key levels to the downside that, as long as they hold, with RSI remaining in bullish ranges, it makes sense to become aggressive on the long side of the portfolio. Taking a look at our market in a minute now. What are we writing about in our note today to get us going on a Monday? Stocks enter the week near record highs, and that does remain the case. Small caps continue to lag large caps to start the year, and that's playing out as the 10-year yield fades from resistance near the 2% level. We'll take a look at a couple of interesting charts a little later in the show that speak to this dynamic. We're also taking a look at software, which is reasserting a leadership position of late. We'll take a look at the IGV and that chart here later on in the show. And as I said, futures do point to a higher open here today. Looking at the major indices from a power bar perspective, you can see the Dow gave back 47 basis points on Friday. Power bar ratio is neutral, 6 bullish or very bullish stocks for 6 bearish and very bearish stocks. S&P 500 down 30 basis points, 122 bulls to 70 bears in that group. NASDAQ inline performer to the downside, 27 to 7 bulls to bears. Small caps were a slight underperformer relative to their large cap peers. 633 bulls, 247 bears. That power gauge rating has deteriorated over the course of the week, but still remains solidly skewed in favor of the bulls. Bonds upticked, sending yields lower. And according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish, but the major indexes currently enter the week in a mixed position. Now, our stock of the day. Speaking of bank earnings kicking off, all eyes will be on the banks and the financials this week. Connect One Bank Corp closed at 25.21, down 98 basis points on Friday. Ticker symbol CNOB. Has a very bullish Chaikin power gauge rating due to very strong earnings performance, very strong price volume activity, as well as very positive expert activity. The financials are middle of the road, but when we take the 20 factors, 5 in each of these 4 categories, we come out with our very bullish rating. So a very bullish stock in a strong trend above the rising long-term trend line in a strong industry group. We've been talking about the banks for the past few weeks, really getting close to a couple of months now, that we've been talking about leadership in the bank stocks. Taking a look at CNOB, the ribbon at the bottom of the screen tells us where that rating is and has been, and we can see we are currently on a very bullish rating for a stock that is outperforming relative to the SPY. Money flow has been, pretty much bullish since the August timeframe, and the stock is now oversold. So we have the setup here for CNOB, Connect One Bank Corp. Now, they are set to report earnings on Thursday, the January 23rd. What I see here is a breakout and a consolidation above the breakout level, above the rising trend line. Oversold stock leading the market, bullish money flow. Folks, this is the setup. CNOB looks like a compelling name here on the long side of the portfolio. If you were looking to add a name within the financials and within the leading banks, CNOB is certainly one that makes sense. Take a look at it, figure out what your risk process is for your time frame, set your stop. But this setup looks compelling to me. Take a look at CNOB on the long side of the portfolio here on a Monday morning. Looking at our sector tracker now. Movement of the major sectors over the last 5 days. Comp services had a really good week. Some of the big FANG-type stocks in that group beginning to outperform the market, really reasserting itself to the upside. As well, technology, the largest weight in the S&P 500. If you are a bullish investor, you like to see technology outperforming, and that has been and does remain the case as we enter a new week. Healthcare, one of the groups that we've been focusing on lately. Now, it's going to be a big week for healthcare as the JP Morgan Healthcare Conference that takes place every year in mid-January out on the West Coast kicks off in earnest today. Utilities, staples, discretionary, and REITs are middle of the road, all higher over the last 5 days of trading. Trading lower over the last week, industrials, financials, materials, and energy. And it's interesting to note that energy really couldn't get much upside traction when oil was rallying, and now oil is starting to pull back, and energy names are beginning to fade again. Remember, we've been talking about how downside momentum in energy was waning, but the group just wasn't ready yet. Financials probably under some pressure with yields pulling in. We'll take a look at the yields a little later in the show. And industrials struggling to get traction, but important to remember from a relative basis anyway that industrials have a big weight to Boeing. Our industry in focus today, insurance services, which over the past 6 months has underperformed the S&P 500 by a little over 6%. However, its power bar ratio, which measures future potential, is very strong. 18 bullish or very bullish stocks for 5 bearish or very bearish stocks in the insurance services group. And it's currently ranked number 6 of 21 subsectors. Now, it has moved down 2 slots over the past week. Some of the indicative names there: American Equity, AEL, MetLife, MET, and Unum, UNM, all have very bullish Chaikin power gauge ratings. But when we take a look at the group, we can see an interesting dynamic. Now, remember, this is a group that we liked a lot through the majority of 2019 as it was an outperformer. However, in October, it began to underperform, and we began to back off that view. Group does remain an underperformer. KIE is the fund we're looking at. It does have a neutral ETF power gauge rating and a weak trend as it closed below the long-term trend line on Friday. Money flow is predominantly bullish. Fund is neither overbought nor oversold, rounding out of that oversold condition. So I think you really have to be selective here within the insurance group, really key in on the bullish and very bullish names, while recognizing that, at least for now, relative performance is not a tailwind for investments within the insurance complex. So just something to keep in mind as we go forward here this week. Taking a look at what's trending now. Friday's S&P 500 movers and shakers are gainers and losers. Lennar reported earnings, revenue, and EPS beat, stock higher by 3.5%. TSN caught some positive comments on Mad Money that sent that stock higher by a little over 3%. Abiomed didn't see anything company specific. I will note that they are scheduled to present at that JP Morgan Healthcare Conference later today. ROL, a very bearish stock, up nearly to 3%. Nothing company specific driving that trading. And L Brands, LB, up 2.37%. after catching an upgrade from Deutsche Bank on Friday. On the loser side of the board, Harley-Davidson under some pressure. Didn't see anything company specific to drive that stock lower by nearly 4% on the day. Same goes with IPG Photonics, down 3.13%. Nothing company specific, but both of these stocks have very bearish ratings at Chaikin Analytics. Arconic, ARNC, part of that aerospace and defense group, they are splitting themselves up. The stock was down 8% on the week, culminating with a greater than 3% decline on Friday. Devon Energy, DVN, down 2.9%. The energy group was weak on the day. And Constellation, STZ, after reporting earnings and seeing a bit of a rally, that stock did catch a downgrade on Friday, which sent it lower by 2.75% on the day. Constellation does remain with a very bearish rating here at Chaikin Analytics. Now let's dive into the charts now. It's Monday, so we look at themes across asset classes, do a lot of our macro and intermarket work. Take a look at the 10-year yield here. The TNX started to rally in the August-September timeframe, a choppy sawtooth trend to the upside, got up near 2% and then began to fade. 2% lines up with the declining 200-day moving average, and we are now testing support at the 50-day moving average. Still have a rising trend line off those August-September lows, but it's interesting to me that the RSI during this rally never really, or did not at all, become overbought. So that tells us that this rally off those August lows did not have a lot of upside momentum, and now we've run into trouble just below resistance at the 2% level. Now, the RSI, in fairness, has also not become oversold. It's middle of the road, so maybe we see some choppy trading in between 1.7 and 2% in the near term, but it's just kind of interesting to me that off that rally, after a precipitous decline, RSI could not become overbought, signaling that there wasn't a ton of upside momentum to this move off of the August-September lows. And now let's take a look at small caps, because here's the interesting relationship and dynamic that I said we were going to touch on. What we're looking at here in the main part of the chart is the IWM relative to the SPY. So small caps relative to their large cap peers. And after bottoming in September, retesting the low in August, small caps actually began to outperform, and we started to become a little bit more excited about the group, especially as that outperformance was coinciding with a breakout through the key 160 level on an absolute basis for the IWM. Now, as we get the year going, actually started late last year and continues as the new year gets underway, small caps begin to underperform their large cap peers, and that's played out largely as the 10-year yield has started to fade from resistance at the 2% mark. What I've given you at the bottom of the screen is the correlation between the two. So the correlation between small cap relative to large, IWM relative to SPY, and the 10-year yield. And you can see that over the past year, for the most part, the 63-day correlation has been positive. So as yields moved up, small caps began to outperform, and as yields have now started to fade from resistance and actually begin to move lower, small caps have started to underperform again. So it's an interesting dynamic that we're watching closely. For those looking for ideas within small caps or strategic positioning within small caps, especially on a relative basis, I think you really need to be paying attention to what's happening with yields. That's why we do this work across asset classes. It's called intermarket analysis, and it's something that we pay a lot of attention to. And finally, software regains a leadership position. We're looking at the iShares North America Tech Software ETF, IGV. Went into a consolidation late in the summer, breaks topside and continues to move higher. The move is confirmed by momentum. Notice during the sell-off, RSI did not become oversold, and now on the rallies, it is able to become overbought, telling us that there is upside momentum to this trend as it trades above the rising 200-day moving average. On a relative basis, IGV against the SPY, we can see that same consolidation and now a topside breakout. So small caps, software rather, reasserting a leadership position relative to the broader market, I think it makes sense to go hunting in that area. Have a great day, everyone. I will be back tomorrow.